Welcome back to 7-Minute Options. All right, today I'm going to look at two different positions that I have open. I'm going to manage one of them, and I'm going to give a great example as to why I just love options. Options are awesome. All right, check this out. So if you guys recall, a FUBO is the first position that we're going to look at today. So FUBO is the position I opened 1 day ago. So what we did a day ago is I bought 100 shares of FUBO at $20.66. I'm actually losing $7 on the 100 shares, right? I bought FUBO at $20.66. Right now it's at $20.58. So if I only bought the shares, then right now I would be basically in a position being down $8. However, I also sold the $25 call on the June 18th expiration, and I sold the $17.50 put. I collected $86 in cash for selling the call, which essentially became a covered call, and I got $83 in cash for selling the put. That's $169 that I collected. And if you look, because FUBO actually is up a little bit today, it's up 4 cents, and because of time premium and IVR and all that, my call is actually trading for only 73 cents today, which means I sold it for $86. I could, if I would want to, I could buy it back for 73 cents and pocket a $13 profit there. And guess what? The put is also making money, right? This is when the stock is going sideways, which when you're selling options, stock going sideways is fantastic. So the $17.50 put I sold for 83. Right now it's selling for 73 cents. So I could buy it back for 73 cents and pocket the $10 difference. So check this out. Today, if I would close all these three positions, I'm not going to, but if I would close these three positions, right, I would make $10 on the put, $13 on the call. I would lose $4 on the shares, but I would still be $18 ahead overall. So in 1 day, I'm up $18, and the stock hasn't moved, right? If you look, I bought it for $20.66. It's selling for $20.63. Okay, so the stock went down by 3 cents or whatever, 2 cents now, and yet I'm up $20. And if I look at it on the graph here, you can see this line represents where I opened the position. This is the expiration, and this one is my 17.5 put. This one is my 25 strike. And the dashed line represents where I bought the stock, which was at $20.66. And so this is a great example of how a stock just going sideways is great. And again, with the covered call, if the stock goes up, even if the stock takes off tomorrow, I'm still going to pocket a nice profit. I'm still going to keep this $4.34 margin that you see here. That's all for me to keep because my sold call doesn't kick in until 25. And if it goes down below this line, then I can roll it, I can buy it back, etc. Or I can just pick up more shares. But this is a great example of how a stock going sideways, even down a little bit, and look, I'm still making money. So this is a great example of why options are just so versatile and so much fun. All right, so FUBO is doing really well after 1 day. We'll keep an eye on it. If I look at the other one I was going to look at is Twitter. All right, so 17 days ago, I sold a put on Twitter. Now you see the word Jade Lizard there. I mean, it was an earnings play. That's a bit of a complicated strategy. We'll get to it in a future episode, but I sold a call credit spread and I made a ton of money on it. I made a little bit of money on it. I closed it. I took my profits there. If you look at the put, I sold a $59 put. Twitter tanked after earnings, so I'm in a losing position on there. Because I had a couple of rolls already, you don't see it there. But let's look at this $59 put on its own. It's expiring in 15 days, and I don't want to keep it much longer. So what I'm going to do is I'm going to look at Twitter for a second here. And you can see here, there's my $59 put. It's represented by that solid line. This was the earnings play, right? On the earnings, boom, Twitter went down. The volatility spiked a little bit, which is normal, but then of course the volatility dies. So the volatility usually dies down after earnings. So when you do an earnings play, you typically want to sell options when the volatility is high prior to earnings, and you want to buy them back when the volatility is lower. Because again, the options pricing is going to drop very quickly, right? That's what they call volatility crush. Now, what I can do with this is I can just say, you know what, Twitter's coming back. I can kind of wait and see what happens. What I don't want to do is I don't want to end up with Twitter shares. And the reason is, I mean, Twitter's trading at $54. Picking up 100 shares would cost me $5,500. And that's just a little bit too much for my account size. You can see my buying power here. I just don't want to end up with $5,000 in just one underlying. So what I'm going to do is I'm going to kick it down the road and collect money. All right, so what I'm going to do here with the $59 put is I'm going to buy it back at a loss, and I'm going to sell the same put at a future month so I can get more money. I'm actually going to get paid to do that. The reason is time premium, right? The longer you have until expiration, the more risk you hold, the more people will give you, the more money people will pay for that option. And so the more premium I collect. So yep, I'm taking on more risk and I'm getting paid more money. So if I look at my Twitter position, you can see I can buy back this $59 put for $4.75 or $475 today. And if I look at, say, that's expiring June 4th. Let's go look at the June 18th expiration. And you can see actually I don't have a 59 put, but I can sell the $60 put and get $135, right? I could also sell the 57.5 put, but I would have to pay $52. That becomes a DB, a debit. So if I go to 60, I collect $135 in credit. So that's only $1 extra. So why don't I do that? Now I can do it that way. I can also click on the right side here. I can roll expiration. And you can see the same thing here. I can roll it out to June 18th and pick 130. So you can do it automatically. I just wanted to do it step by step to show you guys how to do it and what it all means. So I'm closing one position. I'm opening up the same, or in this case, very similar position. I'm collecting $130. I'm going to hit, actually, I'm going to get filled on this. I'm just going to go 131, a little bit lower. I want to make sure that there is a lot of people in this one. Yeah, there's 17,000 people in this one. This is going to get filled. The market is a little bit wide at 15 cents, but there seems to be enough open interest and it's a round enough number. I feel comfortable making this this trade here. So I'm going to hit review send. And there you go. I collected credit for it, right? So you can look at my activity there. Boom. I got filled here. And so what actually happened is you can actually see it. I bought back the 59 put. I sold the 60 put and I collected $133 in cash. So what I'm going to do here is this actually just moved up, right? This used to be at 59. Now I have to move it up to 60. So I'm taking on, that's an extra $100 of risk, right? I moved up from 59 to 60. But I also moved out in time, which means there's more time for this stock to move back above 60. At the same time, I'm holding the stock for longer, which means if there's a market crash, then between now and June 18th, I'm holding this option for a longer period, which means there's a more time risk there. So I'm taking on a bit more risk, but I got paid off very handsomely. And if you think about it, I'm taking on an extra $1 of risk, but I got paid $133 to do it. I'll take it. And that's $133 that went into my account straight away. So there you go. Options are awesome, man. Thanks. See ya.